This is our Forex blog for April 14th, 2014, and these are our currency indexes, which show you as a chart what each individual currency is doing. Here you can see the dollar gapped up. It's above its hourly moving average. It keeps making higher highs. You want to buy the pullbacks, makes a higher high, buy the pullback, makes a higher high. Pretty much kind of a double top right here. That's the potentially end of this uptrend. As long as it remains above its hourly moving average, you certainly can look to buy this very strong dollar, and you want to buy it against the currencies that are weak. The euro is underneath its hourly all day, as it was Sunday. And if you look at some of the other currencies, you can see the Swiss also is underneath its hourly. The New Zealand was as well. So let's just take a look before I show you our signals for the day. Let me show you New Zealand dollar. Let me make sure this is right. Yeah, the New Zealand's weak, the dollar's strong. We're looking for sells in this earlier in the day, especially when the dollar was, pulling back and making higher highs. So here we have a sell right here. If you got short right here, you can do quick little scalps, or if you're, a longer term trader, you probably might have got stopped out there. And once it makes a higher high, you can see from 7-11 the dollar is losing its strength. It's kind of going sideways. If you go back to the New Zealand, you can see it's been trending up, and it's kind of going sideways, slightly higher slope of uptrend than the dollar was. Here's our signals for the day. Here's the euro. And you can see we found a sell up here, which led to a big move, and a counter trend trade right here, which also led to only about 15 pip move, but it found about over 50 pips in the euro. And here's the pound. Did a very good job of finding this reversal. We have a very interesting method of finding whether people are buying or selling on any given bar, and that combined with our statistical tools and our range bar patterns tends to do pretty well. You can see it found a nice little sell here, nice little sell, very small 8 or 9 pip win there, huge win, small win, small win. But again, we're converting our Visual Basic trading signals into C++. It's taken the last month. It's 15,000 line Visual Basic program. I'm about 60% done. We're going to release our first version of it this weekend, and as you can see, it does pretty well because C++ is a much more powerful language than Visual Basic, and I've coded up about 80 different unique bar patterns that tend to repeat. Each one is extremely rare. You might have 1 or 2 signals a month, but when you have a lot of them combined, it does very well. It looks for double tops, double bottoms. It looks for W patterns. It looks for head and shoulders patterns. It looks for fib retracements, fib targets, and a slew of other pattern-based trades. And it also uses about 48 different support resistance areas. If the market makes a certain bar pattern that shows there's buying or selling, if it hits the support resistance area, we also put up buys and sells. So there's a slew of good trades every day in most currencies. But until that comes out, you can continue to just trade with our currency indexes. As you can see, again, the euro was weak. Let's find another one that was strong today. The Australian. So basically, weak euro, strong Australian. You want to sell the euro Aussie. And as you can see, just pretty much straight down all day. Currency indexes are a pretty easy way of trading, especially when you have a nice little range like this that breaks out. You could also sell this little pullback here and here, and then you also have another range, rectangle range breakout. Now, the farther down it goes, the more likely you're going to get a bounce. So I personally prefer, once the market starts making a decent sized move, wait for a pullback, draw your trend line off the lows, get short. This is your, anytime you have a trade with a very tiny risk and the potential profit is bigger, it's very likely to make its way back to the lows. Most of the time weak markets do. They form double bottoms. That's what causes a reversal. So you have a good potential risk reward ratio here, and even if you got out somewhere around here, you know, you pretty much broke even on that trade, but you had the opportunity to make about 20 pips on there while risking 10. And the other ones had much bigger wins versus risk. Small risk, bigger profit. And that's the key to trading.